My name is Michael Blakely, and I am the founder of Entrepreneurs Collective. And you're joining us this evening for a workshop on wealth management as part of our Springboard 2021 series. So I know last year was tough for everyone, but also in particularly for startup founders who, have to work from home, and we've seen a lot of sectors decimated. So we wanted to put a series of events this year to get your startups up and running to the best of our abilities. Next slide, please, Daniel. But first, just a little bit about me. I'm a multiple times founder. Before founding Entrepreneurs Collective, I was a lawyer. And after becoming a lawyer, I went a bit rogue and actually built a dating app. Now, why the hell did I go and do something like that? Who knows? But it was tough. I didn't know what I was doing. I had to build a product. I had to fundraise, work out how to manage a development team. And the first year or two were tough. Now the company is doing great. We've got over 100,000 users. We're post revenue, and we were recently featured in Forbes and and on the BBC. But those first couple of years were tough, and a lot went wrong. And I spent some time looking for community, somewhere, swap, get advice from other founders, and I really struggled. And being an entrepreneur, I got together with some of my founder friends, and we decided to put on our own events. And that's at the start of the Entrepreneurs Collective, and really chimes into our mission, which is founders helping founders. And that's one of our pitch events that we host on a monthly basis, helping our founders to fundraise. Next slide, Daniel. We offer a whole range of services, from pitch events to mentorship, deck reviews, help with fundraising, and lots of credits. So, if that's something we think you can help us, please do reach out. Daniel will put my LinkedIn and the LinkedIn of the speakers in the chat. So if you want to connect to any of us, please do reach out on LinkedIn. In terms of the event tonight, the next event, we have an event on Thursday, next Thursday, which is on accounting and how to audit your startup and to scale it up for the next level. But tonight, we are very lucky to have with us Vermeer Partners, and we have Charlie, David, and Tim with us, who together have a combined experience of 350 years of investment experience. Oh, no, not between you guys.
No, I was going to say.
Over 100 each, unless one of you is secretly 200.
I've discovered eternal youth on the evening.
Very good, very good. So these guys are entrepreneurial nature like us. We love the fact that, Vermeer Partners was started in the last couple of years by guys like yourself, and we're very proud to have you as sponsors. So very interesting to hear from you guys tonight, your take on, how to build your investment portfolio, but also to hear your thoughts and tips on how to invest in 2021, and maybe some discussion as well about all the craziness that we've seen in the last couple of months in the investment world with GameStop and some of the other companies. But less about me. Let's hand you over to Charlie, who will do some further introductions. Sorry, I should say also, we are recording this event. It will be going out to our mailing list, so it was 4,000 or 5,000 people who are part of our community. So if you have any questions or personal information that you don't want to share, then please don't raise it in the questions. Or if you do, please come and tell us so that we can edit as appropriate. Any questions for the guys, and please put them into the chat. They may deal with them at the time, or they may raise them towards the end. So yeah, but without further ado, over to you, Charlie.
Thanks, Michael. You've stolen some of my lines. But thank you, Michael, for the introduction. Good evening, ladies and gentlemen. My name is Charlie Todd, and I'm one of the investment managers at Vermeer Partners. I'm here this evening to introduce the partnership with the help of my colleagues. It is a privilege to be sponsoring the Entrepreneurs Collective, and I have a huge amount of admiration and respect for what they do. In my opinion, entrepreneurs do one of two things. They create something new, or they seek to rectify something that is broken. Vermeer is a startup with an entrepreneurial spirit, bound together by a shared drive to manage money better. David, Tim, and I are here to convince you that there has never been a more important time for your money to be managed well. On a personal note, I've worked in the industry for 10 years, and I live in Wandsworth with my wife, a private chef, and our 18-month-old son. If there are any loud bangs or crashes through the door, please accept my apologies in advance. Vermeer Partners is an investment company founded by a core of highly experienced investment managers with a combined experience of over 350 years, as Michael's just told you. Our entrepreneurial culture is strengthened by a proven team that has spent much of their careers together. There are two separate parts to the business. On the one hand is a private client business where my colleague David Malpass is one of the senior portfolio managers and partners. David.
Yeah, thanks very much, Charlie. I'm not sure you can see me, but if you can, that's great. Evening, everybody. Yeah, I've been working in the industry since 1984, which was the day that British Telecom floated on the stock market. The time of Thatcherism, the entrepreneurial spirit had rebounded from the dreadful times in the 1970s. I've been in a number of companies since then, ended up at Vermeer working with Charlie. I've known Tim, who you'll speak to in a second, introduce himself, for about 30 years as well. And we've got a lot of experience in managing money for investors. So with that, over to you again, and Tim, Charlie.
Yeah, and on the other side of the business is the Vermeer Global Fund, run by one of the founders of the company, Tim Gregory. Tim.
Good evening, everybody. Thank you very much for sparing the time to meet with us tonight. I hope you find it useful. My name is Tim Gregory. I've been a fund manager for 35 years. I started working with David back in 1986. We went in various different directions, including I had 15 years work experience in Australia, where I worked as a remote CIO, which was a very interesting challenge in a startup business. So this is my second effective startup in the wealth management industry. It's great to be working with David and with people like Charlie, who are the younger guys in our firm who really embody the entrepreneurial spirit, and one of the reasons that I was very keen to start this venture. So with that, I look forward to catching up and talking to you a little bit later, but now back to Charlie.
Thanks, Tim. So both sides of the business share a passion for investing, and I hope this evening will give you an insight of how we operate and what we advise in a post-vaccine world. So David, what makes Vermeer different to other investment firms, and what is your personal approach with clients and their money?
Yeah, thanks, Charlie. I think the key thing to just start off, you'll see that there are various slides if you want to look at. You'll be able to take those away at the end of the evening. I don't propose to go through them in great detail. I know you're all in lockdown, been staring out of the window. It's pretty dull. We're going to try and keep you focused. So why did we set up Vermeer? Well, Vermeer is a small, in the world of private client fund management company. It's a partnership. It was put together by 9 partners, all of whom have worked together for literally up to over 100 years, as Michael alluded to earlier on. We've come from a background of working in large financial institutions where, because of various changes that have occurred in the industry over the last 20, 30 years, it's become more and more difficult to run one's clients' money in an entrepreneurial spirit. It's been much more about sort of box ticking, following models. And later on in the presentation, I'm going to touch on a company called ITM Power, which really resonates all the reasons why we've decided to set up Vermeer Partners. And just to give you an idea, the company was set up in November 2018, and the 9 partners of the Vermeer partnership side, LLP side, could not speak to our clients for 6 months because we had contractual obligations. We started in April 2019. Charlie was already there to set the business up, put in all the groundwork with some other colleagues. And as of today, we're now managing 1.6 billion in terms of funds under management. And that is split between a variety of individuals, trusts, charities. And amongst those individuals, we do look after quite a few entrepreneurs like yourselves. They come from a variety of different backgrounds, from music to sport, entertainment, general industry. Obviously, we can't mention them by name, but the fact that all these people decided to follow us to Vermeer gives you an idea that we have been doing something right over the years. And I think that has resonated with many of our clients. How do we actually do it, Charlie? Any other questions on that?
No, I don't. I can't see the questions until I think at the end. So
yeah, okay. So how do we actually look after the clients? Well, it's very much a bespoke process. That the person that you, as a client who comes to Vermeer, meet and talk to, do have responsibility for running your money. So I work in a team of 3. I'm the head as the partner. I work with Charlie, a chap called Simon Barrell, our secretary called Sula. You'll see the names on the presentation. All of them will have knowledge of each client that we look after. It's very much, as I say, a personal relationship with those clients. We discuss with them before they join the firm their risk parameters, whether they're looking for growth, whether they're looking for income. And then really it's a long-term story. We report to them every quarter. We give up-to-date valuations whenever they're required. It's a sort of long story. Every time we make a change to someone's investments, we give reasons why we've done it. And I think that's quite important, because a lot of investors end up being looked after by firms where all they ever get is a report with no more information other than a little bit of performance, sort of a view about markets, with nothing in depth. We at Vermeer look at the world very much from a global perspective. And in a minute, I will show you a prospective portfolio which Charlie's put together, which will give you a bit more of an idea. I don't want to steal any of Tim's thunder, because he'll talk more about sectors and interesting areas of the stock market. I just wanted to give you a little bit of background as to how we at Vermeer look after our clients. I've known some people literally for 35 years, known the family, got to know their children, their grandchildren. And having someone like Charlie working with me now, who's obviously a lot younger, as you can see from our faces on the screen, it's very good to have succession in place, so that when I retire, there's someone there to take up the mantle. And as I say, it is very much a long-term theme. Investing in the stock market, investing generally, is not a short-term phenomenon. As you all know, as entrepreneurs, you know, when you set up a business, A, you've no idea whether it's going to be successful to start with. And B, when you put the money down at the beginning of the whole journey, you may well not even be earning any income from it. So one of the things we do with our clients is we work out what they're looking for in both the short, the medium, and the long term, and we put together a portfolio designed on that basis. We have to take into account risk. And on that, Charlie, do you want to go to page 5, which is that example client? So here we've, what we tend to do is when we meet new customers, as you can imagine, we do quite a lot of this. We always take an example portfolio. And this is a one that's headed the Entrepreneurs Collective Charitable Trust. So for example, if you were looking to set up a charity, this would be something we could do for you. We have to work out the investment objectives with the trustees, and you'll see here that the idea is to generate a balance of growth and income. The risk is defined by what exposure one has to equities at any one time. So medium risk means that there can only be 75% exposure to stocks and shares at any one particular moment. We take a long-term view, so 5-year time horizon. A lot of charities are very interested in the ethical side to investing. So that's something that Tim will touch on later on. And then Charlie, do you want to actually go to the live portfolio, which is on page, page 8. So this is something that you would be receiving on a quarterly basis from us. You'll see that there's a list of various holdings in that portfolio, split between equities and collectives. Equities, the equity is a mixture of direct stocks in interesting companies, and then collectives are essentially, we use those for either geographical exposure or specific sectors where we feel it's inappropriate for us to pick individual companies. And we also, in a portfolio with a medium risk approach, we need to make sure that there is exposure to non-equity based assets. That can include fixed interest, you'll see on the top left, and then what we call alternatives, areas such as infrastructure, property, precious metals, which has been very much in the news this week with the price of silver being chased up by a lot of speculation, which we can touch on later on. I'm sure we'll have questions on that. That portfolio in front of you starts with 250,000. The yield is 2.6%, which generates an income of 6,600 a year. That's always very important for charities. You know, as I said earlier, some clients want income, some clients just want growth. What we're looking for is a balance.
David, one question's come in from Nick, and it's probably quite apt for this. Does your team, i.e. do you and I, invest alongside your clients in similar investments?
Yeah, so what we don't tend to, well, we never show our clients exactly what stocks we personally own, but what I can say is that many of the holdings that we invest in for clients are also owned by us as individuals, and also the funds that we invest in. And I think it comes to our charging structure. We charge a fixed rate based on the value of the portfolio, which is 1% up to $1 million. And I think it's always important to say to the client that our interests are very much aligned to yours, and that the better you do, that way around, the better you do. And I think that's vital. We don't charge commission, we make changes to a portfolio. We don't charge when we're dealing in foreign currencies. We get pretty much the spot rate because we use a house called Pershing for holding our assets on behalf of our clients. So clients' assets are ring fenced from Vermeer Partners. You know, we are a small company. We want to make sure that the risks to our clients are as small as possible. I think that's very important. David,
one question I'd ask, and I kind of know the answer, but if you have someone come up to you and say, I need some money in a year's time, but I want to invest, what's your usual response?
My usual response is that I wouldn't take the money, because I think everything we do is based on the long term. And if you turn that question around another way, if you're sitting with a portfolio, it could be worth anything, but say it's worth £2 million, live client today, client comes on the phone and says they're looking to buy a house in the next 6 to 9 months, and it's going to cost them £1 million, then 99 out of 100, I would recommend that the money is raised today. So you're not taking a risk of short-term movements in the market going against you. And there are examples where it can go very wrong for clients. A good one would be this March when COVID first showed its ugly face and markets fell dramatically. You know, we had a client, anonymous obviously, who didn't tell us they were looking to buy a house until the middle of March, by which time markets had fallen by 35%. If only we'd known 2 or 3 months earlier, and they wouldn't have been selling with the market falling out of bed.
Thanks, David. Now, as you can see in this example portfolio, we also have the Vermeer Global Equity Fund. So I thought this would be a good moment for Tim to run through his fund. Tim, over to you.
Thank you very much. Charlie, just because time is pressing, why don't you move on to slide 14? In fact, just the next slide. Go to the next slide. Oh, well, actually, okay, we'll start there. So that's just a snapshot of the performance of the fund, which was launched 4 years ago. And just to answer the question that David got already, from my own perspective as the investment manager of this fund, I invest all of the money I allocate to equities into this fund. I don't own any individual equities at all. This fund has a maximum number of stocks of 60. It invests in the UK, US, Europe, Switzerland, Japan. It can invest in China, although I don't have any investments in China at the moment. We prefer to invest in Chinese, in interesting areas of China via other companies around the planet for corporate governance reasons. So to the point about aligned interests, we run this money like it's our own money because it is our own money. And that's an extremely important point, that investors can take comfort that the way we manage risk in many sense is common sense, because we think about the fact that this is a substantial amount of our own personal wealth that we've got invested in. It's all the equity allocation in my pension fund, and I don't buy other individual shares outside of this fund. Charlie, do you want to just move on to slide 16? I thought I'd just cover off on a couple of points. In terms of investment process, what we try to do, so we have a maximum number of 60 stocks, minimum number of 30, invest right across the world, right across the market cap spectrum, to a small UK company called Treat, based in Bury St Edmunds, right up to Apple, Amazon, Microsoft, and companies of that size. And you can see some of the themes that we invest in: healthcare, 5G, factory automation. The right-hand side just highlights a lot of companies that we just regard as what we call structural growth companies. Companies like Linde, Train, Toyota, Evoqua, that's sort of part of our ESG thematic. And so there's a very broad spread of investments. And on the left-hand side, you can see our exposure to retail-related businesses. And the theme that you can see recurring through those is what we see as the absolutely critical element of retailing in 2021. And what really came to roost in 2020 was the need for a clicks and mortar approach, or just clicks approach to retail. So it's no longer appropriate really to have just high street locations. What a retail business needs is to evolve a strategy of online digital alongside that. So last year, when COVID struck in March and the market went down 30%, the sort of changes that we made to our portfolio were to add into the portfolio stocks like Amazon that we'd owned in the past and had sold and bought back again. Ocado, we added to the portfolio. Things like that, which are very based upon home delivery and the digital transformation that we're seeing in the world. And you've seen in the last year how well companies have done in the last year that have been part of what we call the digital transformation. I can see a question that says, what was the best performing stock in our portfolio last year? The top four positions: the Japanese merger and acquisitions company Nihon M&A, the renewable energy company Ørsted was one of our best performing companies, and we've actually sold that quite recently because we think it's too expensive. And in the last 2 or 3 years, the best performing share in the portfolio has probably been Varta, which to our like to invest in companies when they're relatively undiscovered, what we would call medium and small cap companies. A German lithium ion coin powered battery company that when we first invested in it was a specialist only in hearing aids and had a very small business in wearable devices. Now all those coin power wearable devices are what a lot of people will be sitting listening to us with their AirPods. They will be powered by Varta lithium ion batteries. And at one point that was we invested in that at 17 euros. And it touched very briefly 170 quite recently. So that's been the best investment that we've made since launch. So if you just move on now, Charlie, quickly to slide 17. This just touches on ESG, which I'm sure a lot of you have heard about in the context of investment. We do not run an ESG fund, but we do think ESG is an absolutely critical part of investment process, and increasingly so going forward. So all the stocks that we own in the portfolio, they don't necessarily have to be ESG qualifying companies. So we do own oil, we do own BP, for example, albeit that is part of the ESG story. There is an energy transition from its historic oil businesses into renewable energy. So we just think very carefully about these things. And the thing that we've noticed, and David will come on to talk to you about something like ITM Power in a moment, is companies that have an ESG related angle are much more interested in a new generation of investors. And we think that that is here to stay. So that's a very important part of the way we think about investments, even though not all our companies by any means would be regarded as ESG companies. Charlie, slide 18, please. So this just is, what we would describe as our USP is the fact that we do invest right across the investment spectrum. So you will all know, of course, about Amazon and Apple and Microsoft and companies like that. But our ability to find small companies like Treat, based in Bury St Edmunds, a UK smaller company in natural products, and really growing strongly in a new industry, actually, the new industry of it's a new form of alcoholic beverage in the US that their natural flavors and ingredients goes into. So grown a whole new part of that business. So we're always looking for businesses like that. And I mentioned Varta, and we've bought into a German combination oven business called Rationale, which had a very difficult year last year because all the restaurants and hotels that it supplies actually had most of their businesses closed last year. But what they did to pivot was they moved their business into dark kitchens. And so instead of their business collapsing, they still managed to do 650 million euros of sales last year, which was down a lot on 19, but a massively better performance than we could have dreamt of when COVID first hit. So those businesses are entrepreneurially run. They have great drivers in their business. And of course, you should remember that Jeff Bezos, who recently this week announced that he would be moving up to the executive chairmanship of Amazon, he is one of the great entrepreneurs of the modern era. And now Amazon is a colossus company, and that has been driven by the entrepreneurial spirit. Just quickly, I'm going to touch on slide 19. It's one of the things that I think is really important about investment and being a fund manager. Most people can invest in good companies, but unfortunately, we all make bad decisions. And how you deal with your bad decisions and own up to your errors is pivotal to how your fund or your individual portfolio, or David's portfolio that he manages on clients' behalf, perform in the long term. Getting rid of the underperforming stocks that you're holding and are hoping something turns up, rather than really genuinely believing when you have a competition for capital within your portfolio, is a mistake. And we work very hard to make sure we cut out the losing stocks in our portfolio, focus on our winners, and redouble our effort to find new ideas.
Tim,
Yeah.
that would be quite a good point to ask a question that's come up, saying which holding has been your biggest regret and why? Maybe over the last couple of years?
Sure. So funnily enough, David mentioned BT, that he started working in the stock market the day BT floated. BT is a stock that has been a difficult investment for many, many years. And it was one of the first stocks that we invested in when we built this portfolio because it looked extremely cheap and had a very good yield. And we felt that the business was turning around. And fairly soon after that, they had a very bad profit warning and we had to cut the position. And it was like a reminder to me that companies that have struggled tend to continue to struggle. And BT was definitely in that category. So I'm not sure it's not the worst investment made because we cut it very quickly, but I regretted thinking that it had changed into a better business. And actually, since we sold it, apart from a recent revival in the shares, it has continued to struggle very badly.
Thanks.
I was just going to mention one other thing. Charlie, if you move to slide 21.
Is it next one?
That I think is 20.
Okay.
So this is just to mention slightly because a lot of global funds differentiate themselves in different ways. And as I say, we invest right across the market cap spectrum, right from down from 300 million pound company in the UK, right up to $2 trillion Microsoft and Amazon. But one of the themes within the portfolio is that we are very keen on Japan, which actually the market in Japan peaked in, I think, 1989 and has been terrible in many respects until quite recently. And we like Japan because we see a big change in corporate governance there. And we also see some great companies. I mentioned Neon M&A was one of our best performing stocks last year. That's a small merger and acquisitions business. But there's familiar names that you would know there. Sony, which had great results earlier this week, and of course is getting the benefit of PS5, but owns a fantastic films franchise, TV franchise, great content, which I think is a very important thing. Cosmetics company Shiseido, the car company Toyota, and we might talk a little bit more about that later. And also a company called Keyence, which is one of the, in terms of factory automation, one of the world's leading companies in vision sensors, and a company that we've had in our portfolio since the start. Started by entrepreneurs, run by entrepreneurs, has 80% gross margins, enormous cash generation within its business, and a totally global franchise. That when the COVID crisis hit, and we really did not know what was going to happen, one of the things that we took comfort in is that if Keyence had no sale for a period of time, they had enough cash with no revenues to last for 17 years. And we thought that was quite a good place to start for a point of safety in a very, very difficult moment. And just as I mentioned with Rational, the German oven business, Keyence's business actually proved to be unbelievably resilient last year. And we saw better results from them this week as we start to see a pickup in industrial activity and a big drive in the digital transformation that we're seeing in the world to greater robotics, greater vision sensors in every factory around the world. So we see those as a big structural theme, and Keyence is a great winner within that. So I'm going to leave it there, and I'm be delighted to take any questions at the end. I'll throw it back to Charlie. I think you've got the slide so you can see all the major positions and the geographical split of what we own within the portfolio, but I'll leave it there and I'll hand back to Charlie.
Thanks, Tim. I'm going to actually ask you one quick question because it's come up. Nick has said, how many of us here are building a tech business? When will the tech bubble burst? So maybe touch on the FANGs. And then once you've answered that question, maybe David can answer the questions about the other area in the market that's seen a potential bubble is ESG stocks. So maybe David can come in and talk about ITM Power and the valuations of those companies. Thanks.
Okay, well, I think without any question, when is the tech bubble going to burst is unequivocally the hardest question for anybody to answer, and we simply don't know. We are more concerned about the bubble bursting because we see some enormous extremes within market activity, some crazily priced IPOs, the new revolution in thing called SPACs. So I think from an entrepreneurial perspective of starting up, I mean, you've got a long way to go through the cycle if you're, not close to IPOing yet. So I think, albeit that there could be a shock and a bursting of the bubble, if it's, if you're early stage in your technology, we'll get through these cycles and great businesses get through to the other side, even if valuations come down from what are pretty extreme levels. So it is something that we worry about. I mean, funnily enough, albeit that shares in what they call the FANG and one or two other companies like Microsoft and Nvidia, stars of artificial intelligence future, companies like that, although their shares are expensive, these businesses have phenomenal balance sheets. They have phenomenal cash flow and great market position. Had really wonderful results earlier this week from Alphabet, despite the problems that Google search has had with travel. So actually, I mean, we don't particularly see those as the extreme valuations within the market, those particular companies. But clearly there are some extremes and you do have to be very careful.
David?
Yeah, just funny enough, we're using Zoom tonight for this conference, and if you look at the share price of Zoom itself over the last 18 months, it's had a stellar return, particularly when lockdown came in March. And the market cap, I think I'm right in saying this, Tim will know in more detail, is now the same as a company called Cisco Systems in America, which is a giant technology company with a lot of revenue, a lot of cash. Zoom, in fact, is not that profitable. So you could argue that the shares have got well ahead of themselves. But going back to ESG and the so-called bubble in that space, I want to just touch on the earlier question Charlie asked me is why Vermeer? Why did we set up Vermeer? And really, ITM Power, which is on page 10 of the presentation, sort of sums this up in many ways. At these larger institutions, when you're running money for clients, there's this adage now, due to regulation, that if you can't buy a stock for every client, then you shouldn't buy that stock. And the problem with that approach is if you're in a firm managing sort of 25, 30 billion, you're never going to be able to invest in exciting small cap companies. And when I came across ITM Power, go back to 2003, it was a small concept company. This idea of using electrolysis to generate hydrogen and to store energy as hydrogen to then push back into the grid, it looked like pie in the sky. But my God, it's changed, because we get to 2020, 2021, and you've seen a whole sea of announcements from governments all around the world, particularly in Europe, who have been enveloping this idea that one of the key ways we're going to improve the environment and ensure that less nasty stuff gets into the atmosphere is to literally reform energy markets around the globe. And green hydrogen, as opposed to brown or blue, which comes out of derivatives of fossil fuels, can only be really produced using electrolysis. And think of it this way: if you wanted to buy an oil company 5 years ago, or even today, there's probably about 2,500 oil companies quoted around the world. ITM Power, hydrogen, there's about 6, and they're the only one that manufactures what's known as PEM electrolyzers. And we've had to be very patient. The shares were trading at 5p for a long, long time. They got up to about 20p 18 months ago. That we stayed with it, with my clients, only a small amount for each client. And today the shares are trading at £6.60. So anybody who owned that stock over the last 18 months has seen their investment multiplied by 50 times. And as you can imagine, we've got a lot of very happy clients. Now, does that mean that ITM is now, along with other companies in this sector and companies in areas such as wind power and solar? I mean, the answer is to a degree, yes. But in the long term, the winners in this industry are going to make absolute fortunes for their shareholders. And we think that ITM is going to be one of those winners. It will get caught up if there's a bursting of the bubble and share prices fall across the sector. But we think that they can justify their market cap, which at the moment is £3 billion. Others in this area can't. And you just have to be extremely careful when you're putting money into a hot area of the market, because 9 times out of 10, you're going to lose money. And I saw a question come up about Bitcoin that someone asked, would you invest in Bitcoin? The answer is that if a client came on to me and asked me to put money into Bitcoin, I would say to them, I'm sorry, we won't do it for you because we think it's too high risk. You need to do that yourself separately. It's just so difficult to make a judgment on something like that. It's a totally new type of currency. If we wanted to hedge against falls in markets, etc., sentiment, we would tend to use precious metals rather than Bitcoin. But Tim's probably got a different view on that.
Tim, do you want to touch on maybe cryptocurrency and also the recent bubbles in GameStop?
Okay, thanks for that. So with respect to cryptocurrencies, just to be clear, we are not allowed to invest in my fund. We are not allowed to. It's a very plain vanilla 60 stock fund, maximum 60 stocks. We're not allowed to invest in cryptocurrencies. I think what is very interesting about cryptocurrencies and Bitcoin in particular is what I think investors have failed to recognize, and why these things have done so well, is the colossal money printing that has gone on by central banks in order to decycle the global economy and to, in the last year, to bridge the economy to prevent first a financial collapse back in March of last year, and then fiscal support that there's been for the government. So I heard a quote. I do enormous amount of results presentations, and I heard a quote that the central banks have issued $12 trillion of liquidity into markets, and the governments, central governments have issued 12 trillion of cash to bridge the economy through this particularly difficult time. And there are now up to $3 trillion sitting in bank deposits, which is one of the reasons why you've seen these extreme moves in things like GameStop. So sort of two answers in one in some respects. So there is concern because so much money has been printed that paper cash is being devalued, and people are looking for scarce assets. And if it's correct that Bitcoin is going to be, albeit that it's nowhere near its maximum amount of issuance at this point in time, but there is going to be a maximum amount of issuance. That is why, and I don't know because we're not allowed to invest in it. That is why it's done so well, because it's, in my view, I mean, there's a lot of speculation that chases it, but its attraction is the fact that it could be a scarce resource at a time when central governments have printed so much money as to render or create a risk that paper money is being devalued. And that is the same reason why so much hot cash has been chasing companies like GameStop and Nokia and things like that. And it's created an environment briefly where there simply is no relationship between the value of a company and its share price. And we step out of that and we don't get involved in that as investors, because we try to redouble our efforts at times like this to make sure the companies that we invest in can be justified by their long-term growth opportunity. And sometimes that's difficult when markets are very high and valuations are high across the board. But some of the things that we've seen going on in markets last week, because of these massive short positions that hedge funds, don't forget that when GameStop was first started to go up, it was because it was 140% of its equity was shorted by the hedge fund community. So, of course, once that starts to reverse and hedge funds have to margin call and buy back stock, these things have a motion all of their own. And that doesn't necessarily mean that it's got any relationship at all, as I said earlier, with the actual value of the company. So these things have been gyrating. They went up massively. They came down massively. It simply is not what we do. And in my view, the movements in those values do not bear a relationship with the values of those businesses.
Thanks, Tim. Agam has also asked, do any of you guys personally invest in it? The answer for me personally would be no. I imagine Tim and David would also be no. The closest we get on our buy list in Vermeer is PayPal, which has been a beneficiary of online payments, and that gives a little bit of exposure to cryptocurrency. One thing I wanted to do finally, I've got 10 top tips for investing in post-vaccine. And following Marco's question, is there a minimum ticket? No, in the fund. For the side of the business that David looks after, I'd probably say £50,000, as long as you kind of follow that on with further cash. In our previous shop or our previous company, it used to be £200,000. But when we started Vermeer, we wanted to make sure that young people that didn't have £200,000 to invest could get involved as well. So I've put some 10 tips together. 1 and 2 I'm going to do, and then I'm going to pass it on to David and Tim. But I've seen a lot of friends that haven't been invested, and their assets are still in cash, and it's not doing anything for them. So I'd follow kind of Marco's optimism, and if you can invest the cash over the long term, you don't need it for the next 18 months, 24 months, then send me an email or go on to Hargreaves Lansdown, look at putting some money in an ISA and start reading up about it. Because the sooner you start, the sooner it starts to compound. And I was looking at the stats today. If we'd given this chat a year ago, and we obviously wouldn't have known that COVID was just about to happen, but within 2 months, your your portfolio, or this is on S&P 500 numbers, your portfolio would have been down 30%, and you'd have probably been saying, God, Charlie Todd doesn't know what he's talking about. But here we are 12 months later, and the S&P is up 18% since last year. And it just gives, I think last year was an amazing year, a total kind of over-exaggeration of falls and rises in a market. But I think point two, where patience is a virtue, is key for the long-term investor. We had a number of clients that, questioned, should they still be invested? Should they still be invested? And, fortunately, their portfolios have performed really well since April. David, I'm going to pass it over to you for 3, 4, and 5.
Yeah, the heading there, All That Glitters, talks about fees compound over the long term. And that's very true. You need to be very careful about investing in products. Just make sure that you're not paying too much to do so, because those fees will affect the long-term performance of the money you've invested. So that's something you have to watch very carefully. And that's why with that example portfolio you can take away when you've left this evening, you'll see there are so many direct stocks, because there's no additional fee for holding shares in a company, but there always are additional fees for buying into to any type of fund, be it a unit trust or an investment trust, even though you don't actually pay the fee yourself. It comes out of the unit price. The next one there, fortune favors the brave. Market reacts fast to the individuals. Look forward, invest for the long term. Be proactive rather than reactive. Very important. In March this year, you couldn't have seen a more apt movement in markets to sort of sum all that up. And remember the saying from the great Warren Buffett of Berkshire Hathaway. One of his great lines is be greedy when everyone is fearful, which is what we saw at the beginning of March, and to be fearful when everybody is greedy. And that's very, very true. Over the long term, his investment vehicle has compounded at about 11% per year since the 1950s. So you need to just invest in a clever way. And one of the themes here is just try and imagine what everyone else is going to do. So don't follow the herd, but just think where they might be investing in the future, what themes they might be investing in. And that's a very sensible way of approaching these things. And then don't judge a book by its cover. Make sure that what you're investing in, particularly if you're not using professional advice, is an area that you understand. I mean, over the years of doing this job, I've been doing it for over 30 years. Clients come on, they work in different sectors. They come on and mention things that they've come across. And actually, they give you some very good ideas sometimes. It could be in retailing. It could be in hydrogen, I touched on earlier. You need to really understand what you're putting your money into before you take the plunge.
Great.
And then on next page, Charlie.
Yeah. So Tim, over to you.
Yeah, thanks. So just a couple of comments from me. And you might say, well, you would say this, wouldn't you? Because you run a portfolio of 60 names. But I mean, I am a great believer in diversifying your risk. We diversify our risk by having 60 different stocks. We invest in different sectors, in different countries. So we do not believe in putting all our eggs in one basket. We run a diversified portfolio. The biggest investment in our portfolio represents 5% of our assets. Sometimes, and David's case of ITM is a good example, when you're running your winners and they do really, really well, like ITM's done for David, obviously it becomes a much bigger part of your portfolio. You need to think about how you risk manage your way through that. And by having a diversified portfolio, that helps you to do that. And I'm a great believer in investing in the best in class type companies. So you find the themes that you want to invest in, you find the sectors you want to invest in, and you find the best company within that sector. That is usually the best company for a reason, and it continues very often to be the best company for a very, very long time, as Amazon has been in home shopping retail for this secular growth period that has occurred. So you can try and find all the different better alternatives that there have been to Amazon, but Amazon has been and continues to be the best example of a stock like that. So do not ever say, oh, it's gone up a lot, I can't buy that. Everyone knows it's a great company. Well, these companies have a habit of continuing to be great companies. And I think that's a great lesson for investing. And I mean, obviously, I think these days, and I think more and more people are thinking about their portfolio in a global sense. You know, Britain does have some great technology companies. I'm sure some of you are great technology entrepreneurs, but of course, there are great tech opportunities in America, in China, in other parts of the world. So I think you need to think in a global context these days. And my final comment is, it comes back to the sort of BT example. Learn from your mistakes. If you make a mistake, you have to accept that, move on, and find a better company to invest in going forward. But do try to learn from the mistake that you made and remind yourself of that mistake when you're about to make it again, rather than think it'll be different this time. Usually it isn't. The same mistakes repeat. So if you learn from them, you tend not to make them again too often. And I'll hand back to Dave for his 10th thought.
Yeah, this is it's quite apt for the moment, actually, but I'm going to go back a little bit. If you were an investor in 1998, 99, and you were clever enough to put money in the first big tech wave, you could have ended up with a portfolio. I mean, here's an example. So I, for my clients back then, put a weighting of about 5% in tech stocks in 98, well before Charlie worked with me. And unbelievably, by December 1999, that 5% had become over 50% of the portfolios I managed. And unfortunately, it was before the days of clients having large sums of money in PEPs and ISAs, which are tax-free. So we were coming towards the end of the financial year, and because that's April the 5th, as you'll all know. And should we take profits or not? And it's incredible how many people made the fatal mistake of not wanting to pay the capital gains tax on their gains and were waiting for April the 5th, 2000. And by the time we got to that date, they'd lost, in many cases, 90% of the money they had invested in that particular sector. And then come to today, we've heard a lot of press coverage about Rishi Sunak as in reacting to the COVID outbreak in the UK, putting up capital gains tax. And I read over the weekend that quite a few entrepreneurs worried about this, worrying that CGT could go to their income tax rate, have been selling their businesses. Well, maybe that will be sensible, but there's absolutely no guarantee that you're going to be getting a great price by doing that now. After all, we're not through the COVID outbreak yet, but we're getting close to an exit with the vaccinations. And in 2 or 3 years' time, what you sell today could be worth 3 or 4 times more than it is at the moment. And therefore, if tax went up, you'd still make more money by holding on. And don't forget, there's no guarantee that CGT will rise. After all, it's a Conservative government. I don't know, I can't think of a single Tory-led government in the history of politics that has raised capital gains tax. So I'm personally not sure that's going to happen. And just as a final thought, obviously you can all invest your own money by going online with places like Hargreaves Lansdown, but investing is can be tricky. And if you want to put your money with a professional, then do contact us. Charlie Todd would be your first point of contact if you're interested in having a managed portfolio with Vermeer Partners. And likewise, if you were thinking of putting money into Tim's fund, I think start with Charlie and then he can introduce you to some of the guys that work with Tim. We'd all welcome any of you. And Charlie, do you want to just finish off with other things we can offer?
Yeah, so Bhavan's asked a question, are you open to clients outside the UK? Definitely. So why did we partner with the Entrepreneurs Collective? I hope you have seen over the last 45, 50 minutes that we're entrepreneurs too. And we know the importance of entrepreneurial success for the economy, and we want to help. So how can we help? For entrepreneurial members, we offer a free consultation to discuss personal finances. I think Michael said yesterday, think of that as a kind of personal audit, and just please email me and we can set up a meeting. As you can see, our primary expertise is looking after clients' money, but we also have a number of clients in the business world, and we will try to help where we can, buying into the motto, founders helping founders. I've already done that with one of the people who did one of the pitch evenings, and we've introduced them to one of the CEOs that we know of a FTSE 250 company. So on the last page is my contact details. Does anyone else have any further questions? I might just ask one before other questions come in, and I'll open it up to both David and Tim, because most of the viewers here will be UK, setting up businesses in the UK. And you mentioned that you invest globally, but David and Tim, what are your thoughts for the UK economy going forward?
Okay, I'm just going to jump in there very quickly, Charlie, just because we're due to finish at 7 o'clock. So I know some people might have other prior commitments. So whilst we've got them on the line, I just want to say thanks to you guys. I think this has been a brilliant presentation. For those of you who need to leave, we'll continue recording the session and we'll circulate afterwards. But for those of you who want to stay, certainly I found it fascinating so far, and I'm keen to hear some more from Tim and David and hear a few questions. So for those of you who want to stay, please do feel free to continue, and we'll stay on and continue this for another 10, 15 minutes or however long it takes. But back to you, Charlie.
Thanks, Michael. Yeah, so David, I think David and Tim, I think most of the people on this webinar are UK-based entrepreneurs. What are your thoughts over the kind of short, medium term of the UK economy?
Do you want me to start on that?
Go ahead, Dave. Go
yeah,
ahead.
Yeah, sure. So the big thing that was overhanging the UK market and has been for a while, there were two things really. There was the fear of a Corbyn government, because naturally his type of policies would not have been very good for entrepreneurs, and also, in my view, the economic growth in the private sector. And then the second was Brexit. Brexit now, as we all know, has been removed. There are still teething problems with the Northern Ireland border and importing goods from Europe, etc., etc. But that essentially, the removal of that as a major sort of stumbling block does make the UK more interesting for the first time for a while. And we, with our portfolios, have started to invest in companies that I wouldn't have even dreamt of buying 3 or 4 years ago. So we do think that the UK is interesting. Valuations on UK companies are very cheap in relation to the rest of the world, particularly in the mid to small cap areas of the market. If you look at the FTSE 100, you'll see that most companies there are global players. They're not really particularly exposed to the UK economy itself. Naturally, if money flows into the UK, they will benefit from it. But if you go down a little bit through the market caps, there are some exceptionally interesting stocks. So yeah, we are putting more money to work in the UK than we have done for a long time at the moment.
Yeah, so I just add my thoughts to that. So obviously I run a global equities fund, and if I want to have no shares in the UK, I can do that. We've never been in that position, but we've also never had more of our assets at about 15% of the portfolio in the UK, and a mixture of it. So I've already referred to 1 or 2 small companies that we invest in, but right up to larger companies like Rio Tinto and BP. So right across the spectrum of companies we own in the UK. So we think the UK equity market is cheap, and I absolutely echo what David said. I think the UK economy has been held back since the Brexit vote. I mean, no matter how you voted in that, what you thought about that, the fact is that has held the economy, the uncertainty that's created for so many industries and for the market and for international investors looking into the UK has definitely held investment back in Britain as a nation. And I think, there's a lot of enthusiasm at the time of the last election. And then, of course, before anything was able to happen, along came COVID as another reason to create another whole host of uncertainty. So I'm really hoping we can get through to the other side of this issue now with COVID, with the vaccines, that hopefully we're through the worst now of the lockdowns, and that money will be put to work to invest in Britain as a nation again, and that our stock market will reflect the better environment for UK equities as well than it has done for a very long time.
Thanks, Tim. One question's come up from Louis Leon, David.
Yep.
If you'd had £200,000 of cash come into your bank account, what would you do with it? Do you invest in index funds of the S&P 500, hedge funds, or anything else?
We don't tend to invest in index funds, to be frank. Because of our skill sets of putting together structured portfolios, we tend to pick direct stocks and pick managers of funds where they've got a good track record, as I mentioned earlier on, in certain geographies or certain sectors. Just to give you an idea on trackers, just think of it this way. If you were investing in biotechnology, which is a very, very exciting industry, been a lot of coverage in the last few months about companies that have either been finding vaccines in collaboration with some of the large cap pharma companies. The thing about biotech is that for every winner, there's about 5 losers. And so if you bought an index that tracks, say, the NASDAQ Biotech Index, you're going to have all those losers in that investment. So we think it's much better in a situation like that to put money through a fund. And the one we like is called BB Biotech, because they're the experts and they will be able to sift through the fundamentals of each company. And they've been very good. They're the best performing fund of its type in the last decade. And they will pick the winners, not the losers. So no, we don't tend to put money into trackers. They are cheap in terms of there's less fees, but you're just tracking an index. So you're never going to outperform it. And the whole mantra of Vermeer is that we're not looking to just perform in line with benchmarks. We're looking to outperform over the long term for our clients. I don't know if that answers that question.
Yeah, that's great. Vipul, David and I usually have about 4 or 5%, well, anywhere between 2 to 5% in cash. But Tim, how much cash do you have at the moment in your fund? And
Sorry, go ahead, Charlie. Apologies.
Go on. What percentage?
So we currently have 4%, broadly speaking, and the most we've ever had is about 16 last March. And we started putting money back to work towards the end of March, early April last year, and we ran that cash down throughout the whole year. So we have the flexibility to have quite a lot of cash if we want to, but we simply manage it probably within those bounds. Probably the extreme would be 16, and where we're at now for us is pretty fully invested.
Tim, I can't help myself. I'm going to have to ask you about Elon Musk and Tesla. And you run a global fund. It's been very successful. So's the Tesla stock. How come you don't own Tesla and you prefer Toyota?
Well, thanks for that fast bumper. But because it was, and the absolute reality is it has been an absolute mistake not to invest in Tesla. Tesla, has been a great innovative company. It went through a phase where actually, it looked like it had, some debt issues, but it got out of all those without difficulty. Share prices performed brilliantly. We haven't been able to get our head around the valuation, but of course the stock has just continued to appreciate further. So we've been wrong, no question about that. And we, as you say, we have invested in Toyota. We think within Toyota is the sort of hidden assets in that they, like David was talking about hydrogen, Toyota's in the process of building a hydrogen city at the bottom of Mount Fuji in Japan. So it has tremendous innovation. It has a plan to sell 5 million electronic vehicles by 2025. It makes enormous profits already, despite the problems of COVID. It has a phenomenally strong balance sheet. It has the Lexus brand, which it sells enormous amounts of product to the Chinese market, so has good access to the Chinese market. So to be honest, it would have been right to own Tesla, not Toyota, in the last period of time, no question about that, and we have been wrong. But we do think Toyota, is an attractive long-term investment. All our investments are long-term. All our investments potentially require patience.
Thanks for that, and apologies. Another question, Tim. What's the main driver for you in your investment? Is it the management team, company track record, or sector? do you ever follow individuals to new companies, and can you continue to back them? So actually, I'll ask you first, and then David, you might want to touch on, I don't know, something like Melrose.
That's a great question. We think that the critical things within businesses, you've got to be in the right industries in the first place, and where great management meets a good industry opportunity and a good structure within a company, or a company that's performed badly in what is a good industry, that represents a great investment opportunity if you can get that right. Usually, when good management meets a bad company in a difficult industry, it still remains a bad company in a difficult industry, even though it improves as a company. Quite often, that doesn't really reveal itself because the industry is so difficult and the business is so difficult. So I think it is one of the most interesting things to do is to follow CEOs who come out of businesses that go into other companies to turn them around. If they're in good industries, that can be a great investment opportunity. Dave?
Yeah, I mean, if you go back to when I first started in the stock market in the late 80s, or mid 80s actually, one of the most famous managers in the UK was a guy called Archie Norman. He ran a company called Allied Dairies, I think it was called. Did incredibly well. He's now in his 60s, and it was quite odd when 2 years ago he turned up as chairman of Marks and Spencer, and I've been thinking about it for a long time. Didn't do anything about it. I thought, why on earth has he gone there? It looked like a sort of defunct UK retailer with no future, very slow to offer an online service for most of their products, food and clothing. And literally in the last 6 months, the outlook for that whole company has changed dramatically. I mean, they've been helped obviously by a lot of their rivals going bust, but they did a tie-up with Ocado. Their online food delivery service has been absolutely inundated. And in fact, it collapsed to begin with, but that's now been ironed out. Ocado is a very efficient business. They've been buying up brands of companies that have gone bust. And suddenly you can understand why he did what he did. And I think right now, Marks and Spencer's looks very interesting as a UK stock and would fit into that box of what I was talking about earlier on as to why, in the UK, there are now some quite interesting companies. And there are loads of in Sorrel, left WPP, Under a Cloud. We won't go into the reasons why he left, but he was caught somewhere he shouldn't have been. And subsequently, he started set up a new business that's doing really well because he's very good at what he does. So yeah, we do follow individuals to companies, but as Tim said, if it's a bad business, it's a bad business. And my saddest memory goes back to the 1990s when you may remember a defense company called Ferranti, and it was a very well-known American businessman who had a fantastically successful career called Eugene Anderson, and he came in to run Ferranti and didn't realize there'd been a fraud within the business, and his last hurrah was running a company that went bust. So one's got to be very careful.
Okay, thanks, David. I think the last question, which I've saved, which is slightly left field, but excellent. What business would the speakers like to start outside the investment management industry? Tim, I'll let you go first.
Oh, that's a fantastic question that I need a moment to think about. What
So I think this is a good time for you to put your investment strategy to work. Is it, the sector, what the trends? I guess you want to go into a sector that's growing fast.
Yeah. Okay. So okay. So I think the answer to that is, if I were in a position to utilize artificial intelligence going forward. So as it's a share we don't own, actually, but a guy called Jensen Huang, who's the chief executive of NVIDIA, he described artificial intelligence as the iPhone moment for industry, the way it's going to transform things going forward. So I think anything linked to artificial intelligence is going to be the most exciting runway for business changing going forward. And that is going to be massively helped by 5G infrastructure as that gets built out.
Good answer. David?
It is a tough question, but I mean, the sector I've always found fascinating all my life is healthcare, pharmaceutical. We as people, we all fear death. We all want to live healthy lives and want longevity of life and enjoyment of life when we're old. And so if I could set up a business that had the technology to predict what problems may emerge within the human body in the next decade, 20, 30 years, through some sort of test, I think that would be a massive business. I mean, we have put money into a little company called Avacta, based in the UK, which has developed these assay tests for giving a doctor some sort of timeline as to whether the patient sitting in front of them could develop certain types of cancer in the future. Just imagine if that proves to be successful. So that's where I would focus my, if I was setting up a business outside finance, that's what I'd do.
And my reply to it is a question or a comment that came up on the chat. I think it was put up by Leon. The answer to that is absolutely yes. Online dating using AI would be a phenomenal. If you had the skill set to try and drive that, I think that would be a great idea.
I think having just been distracted by a Deliveroo moped outside, I think starting a hydrogen-powered moped company would be pretty interesting. So I can't see any questions. Michael, have you got any?
Oh, I think that's you've covered everything, and it's been a fascinating presentation. So well done, guys. The fact that we've got the majority of the audience has stayed for considerably past our allocated time, I think shows just how great a job you guys have done. So well done, thoroughly fascinating stuff. So just to say thanks to Vermeer, again, to reiterate, these guys are experts at what they do, and you should really take advantage of their offer for a free consultation. These sort of things, it's a chance to chat to these guys doesn't come along very often, so please do reach out either through Charlie or through myself. But just to reiterate, an excellent webinar. It's great to have you guys as sponsors. I think the entrepreneurial spirit really came across, especially not only through the presentation, but the questions that you guys answered. So great event.
Well, thank you, Michael. Thanks for the opportunity, and yeah, look forward to seeing some of the audience at some other events, hopefully later on in the summer.
Yeah, well, we'll certainly be doing a follow-up to this event in the not too distant future. So look out for it, guys.
Thanks very much, everybody. Thanks so much for sparing the time to come visit with us tonight. Thank you.
Yeah, thanks, Tim.
Yeah, and from me, thanks very much. I'm delighted that the Zoom system worked all the way through the evening and there were no glitches. That's brilliant. Thanks.
Yeah, great stuff. Well done, guys. Okay, thank you.
Thank you very much.
Thanks.
Bye-bye.